Thank you very much for such a kind introduction. Good day, everyone. First of all, I'd like to thank the organisers for the opportunity to speak here again. Today, I want to give a brief review of the gold price factors that played out since I last presented here in May 2021, and then I'll address the influence on gold principally by those factors, discuss key price points and their significance, maybe make a few gentle predictions and expectations for gold over the next 12 to 18 months. Now, since last May, the world has changed hugely in some regards. Defense think tanks speculate fairly openly on how NATO would likely respond in the event of a low kiloton tactical nuclear weapon being detonated over a Ukrainian city or a town, and at what point that would constitute a meaningful escalation of the conflict with Russia. And I think this has been scarcely imaginable this time last year. In other ways, the world remains unchanged. Asset markets continue to live in the full glare of the fiscal blast furnace that was fully lit in the response to COVID-19 and the post-COVID supply chain issues that have been intensified mainly by two factors. One is the war, and the other factor is the ongoing zero-COVID strategy in the People's Republic of China. The expected pace of US monetary tightening and the likely terminal value before interest rates roll over exceed almost all prior beliefs, as I'll show you. Now, as real yields race higher from the 2021 lows, gold remains under some pressure, owing to the inverse relationship between real yields and the gold price. This, and to a great extent, the strength of the US dollar, which has exceeded my expectations even, helps to explain why both war and some very worrying inflation numbers haven't translated into fresh highs for the gold price. Just a reminder of the principal drivers of the gold price. Those are real yields, meaning nominal yields minus inflation, the US dollar and debt. They're not the only drivers of the gold price, but like my son in the lead up to Christmas, their influence is both powerful and persistent. Now we'll quickly review what happened with the dollar and yields last year and now, partly because when I was standing here last year, the US dollar was close to multi-year lows. Lots of observers were calling it even lower, and I called it higher, so I feel I should enjoy a brief moment about being right about something. Debt has only increased, so I won't talk about that. It's just to say that it continues to be a positive factor for the gold price. And later I'll talk about war in China and inflation. Now, the US yield gap was one of the main factors in expecting a higher dollar price broadly over last year. And that yield gap has persisted and dragged the broad dollar base index higher. And it's accentuated, and I have to thank Deutsche Bank here for this particular research note, by a steep kink in the middle of the rates curve that drags more interest into the dollar. Now, the important issue with US yields is where do we go from here? The substantial tightening that is expected by the Fed will reduce the slope of the curve significantly, and it should diminish the appetite for US dollars relative to other currencies, taking the wind out of the sails, possibly taking the wind out of the sails of the ongoing dollar rally. So that's the first issue that might change relative to last year. Oops. The next issue was an important factor, an important driver last time, was positioning in the dollar. Last year, dollar positioning was extremely low and extremely extended to the net negative. And the net negative exposure like that usually presages a substantial rally in the dollar, and it did. So what's going on now? Now, these charts were made about a week ago because that's the pace at which the data comes out in this particular case. So things have happened since. But as of the moment when this chart was printed, positioning was rolling over. I think it's actually extended now since, which is not surprising given the recent burst higher in the dollar. But the point is that it looks like there's a degree of uncertainty, and it looks as though the red line, which is positioning, shows you a degree of perhaps loss of momentum. So finally, the third thing, and that is the cycle for the dollar. You can see a huge mega cycle, which I mentioned last year, which is about 39 months long. And this time last year, we were almost at the lows of that cycle. And given what had happened before, because history does tend to sort of cycle through, there was a good chance the dollar would go higher, and that would be a headwind for gold. If you look at what's happened now, and I think we may have even gone higher since last Thursday, the dollar's touching resistance, or touching a broad resistance level that extends back many, many, many years. It's also about a third of the way through the cycle, and whilst you can't assume symmetry, it does suggest a lot of what's gone has played out, and we might be near some dollar highs. And therefore, if we are near dollar highs, and that cycle we begin to see the downslope of that cycle, we might actually see a weakening dollar, and so that's something which is good for gold. Real yields, they moved lower as expected. It was really hard to say how low they were going to go because we were already in pretty much uncharted territory, but they made a completely fresh low. I have to say it was a long decline in real yields that helped gold hit the highs 2075 in August 2020. But since then, they've absolutely rocketed higher. And the reason they've rocketed higher essentially is the perception the Fed will stand on the brakes in order to deal with inflation. And that move higher in real yields has been quite difficult for gold. If you look at the sort of purple box that I've put in there, we're now in that zone. That's the area where I expect the move in real yields to sort of peter out and lose momentum. So again, if you look forward from where we are now, this is another sign that actually the factors that were sort of headwinds for gold, the higher dollar, the move up in real yields, those two might be losing momentum and turning around. So the Russian invasion of the eastern part of Ukraine and the high degree of political uncertainty arising, not only from the immediate impact of the invasion, but also from what China will do or won't do, the whole Russia-China axis and beyond, looks to have decoupled gold from the main influences on the gold price that I just referred to. And if you look here, this is all data from last week, so it's actually quite telling given where we are now. All of those sort of red axes that intersect quite a long way above the sort of regression points that you'd expect for the US dollar, real yields, and Brent, all of which influencing the gold price to some degree. So what it looks like to me is that when all this data was run, gold looked a bit overvalued and looked like a highly valued outlier compared to where you'd normally expect to find it. Gold's dropped about $100 and so dollars since, US dollars since, or $80 since. So it's actually tended to converge on where you'd expect it to go, so closer to the regression line. I won't speculate too much on why that decoupling occurred, except that it's probably, to some extent, fear of inflation, and obviously to some extent the heightened geopolitical risk. Now, what happened in February, we had short-term moves that showed funds flowing very rapidly into gold as investors bought insurance against the initial uncertainty of the move into Ukraine. They were exceedingly quick to pivot away, though, once they could take substantial profits. Now there's evidence that funds are moving back in, sort of tentatively into the gold market. Just to give you an idea, funds started loading up at about 1806, 1844, and 1886, and they reduced those bullish bets between 1934 and 1997. So that sort of insurance, if you like, paid off quite well for them. Now, the real-world outcomes and effects on gold from the war are largely through the obvious price shocks emanating from the energy space and to some extent metals and softs, agricultural products. Those outcomes are observable and expected, and other potentially destabilizing outcomes are not. A very summary take on the war as it regards gold is that it can be thought of as a stagflationary event, both raising the price level in the general economy and shrinking the world economy. Now, what I want to point out is something that's becoming rapidly obvious, and as was just mentioned, we might even see evidence of it today, is the rapid tightening that is a worldwide phenomenon. It's just happening everywhere. This is a huge development for asset markets, rapid change in expectations for the cost of money, and these changes have the potential to be epochal in character, given the both very high levels of public and private debt. The proximate causes are the culmination of years of loose monetary policy, followed by a substantial fiscal boost. The helicopter money that Ben Bernanke referred to was choppered in directly by the government, not by the Fed. There's an added and extremely important twist of the utter mangling of post-COVID supply chains. This slide shows 4 distinct data pictures that tell just one story, and that story is the previous era of cheap money is coming to an end, and the investors' decade-long love of risk is at last coming to at least a pause. Cheaper money, of course, might return if there was a significant recession. The slides here show the massive rise in Chinese high-yield debt yields, which is essentially a huge sign of risk aversion. The biggest spike in 30-year mortgage rates since 1980, the rise in Australian yields. The final bottom left chart shows the rapid change in market pricing of August 2023 Fed funds expectations. Last October, the market assessment of the probability that Fed funds would reach a target band of 3.25% to 3.5% was about as good as zero. Now the market prices in a 1 in 3 probability of that happening. That is not insignificant. And the chances of the rate stabilizing at 2 to 2.25% have all but vanished. The market might be wrong about this, but as of now, expectations are huge for worldwide monetary tightening. This is US gold positioning via managed money since November 20. And you can see that the insurance that I referred to earlier, and followed by the sort of slight exit, and now reasonably large return to the gold market. What I want to talk about briefly next is China. It's a story of lockdowns and deleveraging. The Chinese demand rebounded 57% last year to about 960 metric tons. Obviously, it was coming from a massively low base. But China's economy today is defined by 2 important factors that weren't really an issue last year. One is the imposition of zero COVID policies across major cities, Shanghai being the most visible exponent of the policy. Now Beijing and about 45 other cities likely to be affected. The second is the rolling over of a vastly indebted property market. Zero COVID policies are estimated to be impacting China's economic output negatively by about 4% per annum, just from Shanghai alone. They also have knock-on effects on supply chains that result in inflation elsewhere, but also worryingly in China itself. When I mentioned above that there are unknown destabilizing outcomes, high price of natural gas feeds onto fertilizer costs, and lockdowns feed onto the inability to distribute both the inputs for agriculture and food itself. To what eventual outcome only one can imagine. This slide here shows the Shanghai Gold Exchange premium and discount. I've smoothed it over 5 days because otherwise it just looks like an incredible lightning strike. But you can see when Shenzhen and Shanghai started lockdown, there was a significant drop in the premium and a move straight into discount. And if you talk to Chinese banks, they admit they can't even move gold, not only out of Shanghai, but they can't move gold within the vaults itself. So why the focus on China's property market? The reason why is the real estate sector accounts for almost 30% of China's GDP, and the slowdown there matters because it's estimated that about 51% of all investment in fixed assets was driven by real estate, and that 70% of China's household wealth is tied up in property. The sector is about $5.2 trillion in debt, according to Nomura, a Japanese investment bank. Although the government is sending supportive signals right now, it's entirely conceivable that the deleveraging that started this whole problem will begin again after the 20th National Congress of the CCP in the second half of this year. The short-term risk is that a highly leveraged property sector of gargantuan proportions shrinks and causes systemic problems that ripple through China's banking sector and impact local government finances and spending that hit President Xi's common prosperity plans. In other words, there's a risk of sharp contraction in Chinese demand, and that would feed into the stagflation sort of story that I'm putting out here. Now, the long-term risks are that demographics are creating a headwind that makes it harder for China to lever itself energetically out of a slowdown. And like Japan, China's ratio of working-age population to elderly is similar to Japan's back in the 1990s. China will be hitting the same old-age dependency ratio in 2023 that Japan reached back in 1992. In other words, slower growth may actually be baked into China's outlook. There is good evidence to say that stagflation currents are strong based on the aforementioned factors of war in China. And there's also a considerable risk that rapid tightening will not only curb inflation, but also hinder growth next year and the year after. The broad-based dollar rally of 21 and 22 may lose momentum in the second half of this year. Real yields are expected to find technical resistance at 0 and certainly between 0 and 0.25%. And that suggests that the two traditional headwinds for gold could dissipate later this year and next year. Just very quickly, I'll deal with the multi-year view of the gold price. The recent behavior shows a distinct shooting star candle in the weekly chart that gave clear warning of a trend reversal. Gold bounced from the low, but we're still heading lower. Looking further forward, the weekly bar chart shows that a giant double top has emerged between 2020 and 2022. If gold breaks above the March high on stagflationary concerns, the measured target is about 2470 in US dollar terms. And this is borne out by our point and figure targets that suggest that the price can move up to 2500. Of course, we'll actually have to see how stagflation moves. I'll summarize the presentation as follows. The situation is something of the reverse of last year, where the dollar was in the early stage of a strong rally. Now that rally looks mature. Last year was reflationary. The economic outlook now supports stagflation, where growth is poor or even shrinks, but is accompanied by rising prices. This is a good environment for gold. Equities and bonds are under pressure after a huge period of growth, and the world economy faces a twin threat from tightening led by the US and deleveraging in China, both of which are underway. We can't know the full scale of those threats, but they represent a step change from what came before. Gold price targets remain ambitious and plausible above the 2021 lows. I'd just like to mention one last thing, that if any of you are interested, Shay Russell and I run a podcast that comes out approximately every week, and if you wish to sign up for it, you can do so here. Thank you very much.
Nicholas Frappell, thank you very much.